Welcome back, everyone, to the Deep Dive. Ready for another deep dive? This time, we're going to be diving into the Indian economy.
Sounds good.
Specifically, the macroeconomic picture.
Yeah.
You've shared some charts and data with us, all from this Nippon Macros Chartbook.
Yes.
All painting a picture of where India stands, kind of as of February 2025. And basically, we're hoping to help you get up to speed with the latest in economic developments.
Right.
Spot the key trends and really figure out, what does this mean for the future? What does this all mean?
Yeah. And I think what's especially fascinating here is that we're looking at India amidst a global slowdown. A lot of major economies facing headwinds, but India is still, posting some pretty impressive numbers, even if growth has cooled off a bit recently.
Yeah, let's unpack that. The Chartbook shows India's GDP growth hit 6.2% year-on-year in Q3 of fiscal year 2025.
Right.
Which covers October to December of 2024. Now, that's down from 9.5% in the same period the year before, but still considered to be very robust.
Very strong.
Compared to other major economies.
Exactly. And, I mean, the slowdown was, somewhat anticipated given the global economic climate. But what I find interesting is the disparity in performance across different sectors.
Okay.
Manufacturing growth has taken quite a dip, down to 3.5% from a huge 14% the previous year.
Wow.
So that suggests to me that perhaps global factors like weaker demand or those lingering supply chain issues are weighing more heavily on this sector.
Yeah.
On the other hand, the services sector, it's booming. I mean, the services PMI surged to 59.0 in February.
So it's like almost a tale of two economies within India, right?
It is.
Services are charging ahead,
while
manufacturing is facing turbulence.
Yeah.
What does this contrasting performance tell us about India's overall, growth model? Could this reliance on services make India more vulnerable, potentially in the long run?
That's a really crucial question to consider because, India's services sector, particularly IT and related industries, has been a major, major growth engine for decades. But if global demand for those services were to decline, it could definitely expose the economy to some vulnerabilities.
Right.
Now, the government is aware of this and has been trying to boost manufacturing through a variety of initiatives, but it's clearly a work in progress.
All right.
It's not easy to shift an economy's focus so quickly, right?
That takes time.
Okay, so we got this interesting dynamic between services and manufacturing to keep in mind.
Yeah, definitely.
As we kind of explore other aspects of the economy. Now let's talk about everyone's favorite topic, inflation.
Okay.
The Chartbook brings us some good news here. Both consumer and wholesale price inflation eased in January 2025.
Yes, that's a definitely positive development.
Okay.
CPI came down to 4.31% and WPI to 2.31%. And a slowdown in food price increases has played a significant role in this easing.
But the Chartbook does sound a note of caution, rising energy prices and that kind of unpredictable global landscape could reignite inflationary pressures.
Okay.
So it's something to keep an eye on.
So while it's good news for now, can't get too comfortable with inflation.
Exactly.
Right, those external factors could definitely throw a wrench in things.
Yeah.
This brings us to the trade and current account situation, which looks a little more complex.
Indeed. India's trade deficit widened considerably in January 2025. It reached almost $23 billion.
Wow.
That's a significant jump from $16.56 billion in January 2024. And this widening gap is mainly due to a 2.38% decline in exports, coupled with a more than 10% surge in imports.
And what are the implications of this widening trade deficit? Does it make India more susceptible to global shocks, especially given those global uncertainties we just talked about?
It certainly raises concerns about vulnerability. A larger trade deficit means India is relying more on foreign goods and services. And this can expose the economy to fluctuations in global prices and demand.
Right.
If those imports become more expensive because of, global factors, or if export demand weakens, it could, put pressure on India's currency and overall economic stability.
So the trade deficit is something to keep a close eye on.
Definitely.
But the Chartbook also points out that the current account deficit, which includes not just goods but also services, actually moderated slightly in Q2 of FY25.
Right.
How is that possible with a widening trade deficit?
That's where the strength of India's services sector really comes into play again.
Right.
Robust services exports, particularly in areas like IT, consulting, financial services, they help to offset that larger trade gap in goods. And it really highlights how crucial services are to India's external balance.
So the booming services sector is acting as a bit of a buffer here.
It is. It is.
Now let's move on to how all of this is impacting the markets, which, according to the Chartbook, have been a bit jittery lately. The Nifty 50, which is India's benchmark stock index, took quite a tumble in February, down almost 6% for the month. What's driving this market unease?
Well, it's a confluence of factors, really. The U.S. president's recent announcement of tariffs on some key sectors like autos, pharmaceuticals, and chips, that's sparked anxiety about a potential global trade war and its potential impact on the Indian economy.
Yeah.
This is particularly concerning for sectors like IT and auto, which relied heavily on those U.S. markets.
Right.
So you can understand the concern there.
Yeah. And on top of that, we have the RBI's recent rate cut. The first in almost 5 years. They reduced the repo rate by 25 basis points, bringing it down to 6.25%. But the market reaction wasn't quite as positive as maybe one might expect.
That's because the market expectations were for a more aggressive move by the RBI. There was this anticipation for either larger rate cuts or some additional liquidity-boosting measures to try and really stimulate the economy. And so this 25 basis point reduction, while a step in the right direction, it kind of fell short of those hopes, which led to some disappointment and uncertainty in the markets.
So it's kind of a case of good news, but not good enough for the markets. What specific liquidity measures were investors hoping for, and why did the RBI's actions fall short?
Well, markets were hoping for things like open market operations where the RBI buys government bonds to inject liquidity into the system, or a reduction in the cash reserve ratio, which would free up funds for banks to lend. I think the expectation was that the RBI would take a more proactive approach to counter the slowdown and really support growth. And so this 25 basis points cut was seen as a more cautious move, maybe signaling that the RBI is kind of prioritizing inflation control alongside growth stimulation. They're trying to balance those two, which is a difficult thing to do.
And to add to those market jitters, we've got foreign institutional investors pulling money out of the Indian market. The Chartbook mentions continued FII selling as kind of a contributing factor here. Is this a sign of waning confidence in India's economic prospects?
Well, FII selling can definitely signal some concerns about the investment climate. There are several factors that could be driving this trend. It could be, global risk aversion amid the uncertain global economic outlook. It could be concerns about India's fiscal deficit, or even just profit-taking after a period of strong market performance. So it's hard to pinpoint exactly what's driving it, but it's definitely something to keep an eye on.
So we've got global trade tensions, the RBI's cautious approach, FII selling, and on top of that, the Chartbook points out that mid-cap valuations are looking quite expensive compared to large and small caps. It seems like a perfect storm of negativity for the markets.
It's certainly a complex and challenging environment. Investors are weighing multiple factors, both domestic and global, and trying to gauge where India's economy is really headed. Now, let's shift our focus a little bit to interest rates, which have also been on a bit of a roller coaster ride lately.
Yeah, the Chartbook shows that bond yields initially dipped on hopes of a rate cut, but then rose again because of that disappointment with the RBI stance. We even saw the 10-year benchmark bond yield reaching 7.2% in February 2025. Can you kind of break this down for us? What's driving these fluctuations?
Sure. So initially, bond yields fell because markets anticipated a rate cut, hoping it would boost economic activity. But when the RBI delivered that smaller than expected cut and refrained from those more aggressive liquidity measures, it kind of dashed those hopes. And that led to renewed concerns about inflation and government borrowing. And those concerns are what pushed those bond yields back up.
It seems like India is caught in this tug of war between domestic factors and global influences.
It is.
Everything's interconnected, isn't it?
Absolutely. The Indian economy is deeply integrated with the global economy, and those interconnections are becoming, increasingly evident. So let's dive into some specific events that shaped India's economic landscape during this period?
Yeah, let's get into the specifics. So the RBI's February monetary policy meeting, that was kind of a big event, right? It marked the first repo rate cut in like almost 5 years.
Right.
They lowered it by 25 basis points, bringing it down to 6.25%. And as we discussed, the market reaction was a bit lukewarm, with investors hoping for a more aggressive move.
It was a delicate balancing act for the RDI. They're clearly trying to stimulate that economic activity without letting inflation, get out of hand. And so that 25 basis point reduction, while it was seen as cautious, does signal that they are willing to support growth. It's a shift in their stance, even if it didn't meet everyone's expectations.
Speaking of expectations, the Chartbook also mentions the RBI's projections for inflation and growth for coming fiscal years. What's their outlook?
Well, their current projections put CPI inflation at 4.8% for FY25, easing slightly to 4.4% in the fourth quarter.
Okay.
They expect food inflation to soften thanks to those good harvest prospects.
Mm-hmm.
But they do acknowledge the risks posed by, those rising energy prices and those global uncertainties that we keep talking about. For FY26, they're projecting CPI inflation to moderate further to 4.2%, assuming, of course, a normal monsoon season.
So a cautious but optimistic outlook.
I would say so, yeah.
On inflation. What about growth? Are they forecasting a continuation of the slowdown we saw in Q3?
Well, actually, they're projecting real GDP growth for FY26 at 6.7%, with a bit of a front-loaded pattern. So 6.7% in Q1, 7% in Q2, and then easing to 6.5% in both Q3 and Q4. They see robust household consumption helped by that tax relief in the recent budget as a key driver.
Okay.
However, they're not ignoring those potential speed bumps like those geopolitical tensions, the global commodity price fluctuations, and of course those protectionist trade policies that we talked about earlier.
It sounds like the RBI is walking a tightrope.
It really is. Yeah.
Trying to balance those positive domestic factors with those looming global risks.
Yeah, it's a tricky situation.
Apart from the RBI's actions and projections, what other domestic events kind of caught your eye in the Chartbook?
Well, one thing that stands out is the widening fiscal deficit. The government's fiscal deficit for the April-January period of FY25 has already reached 74.5% of the budgeted estimate.
Okay.
That's a significant increase from the 63.6% recorded during the same period the previous year.
Okay. For those of us who aren't economists, can you break that down a bit? Yeah. What does a widening fiscal deficit actually mean?
So in simple terms, it means that the government is spending more than it's earning.
Okay.
And a widening fiscal deficit indicates that they're having to borrow more to cover that gap, which can have consequences down the line.
Okay.
It can lead to higher interest rates, it can crowd out private investment, and potentially even fuel inflation.
So it's not just about the absolute numbers, it's about the trend.
It's about the trend, exactly.
And the potential long-term impacts.
Yeah, exactly.
Is this something that the government's likely to address? Or is it going to be a case of, kicking the can down the road?
Well, the government's going to have to find a balance, right?
Right.
Between supporting that growth, but also maintaining fiscal discipline.
Right.
And they'll need to carefully consider how much spending is necessary to stimulate the economy without making that deficit worse and leading to those potential negative consequences. It'll be interesting to see how they navigate this challenge in the upcoming budget.
Definitely something to watch for.
Yeah.
Any other notable developments on that domestic front?
Well, the Chartbook highlights the index of 8 core industries, which grew by 4.6% year on year in January 2025.
Okay.
This index, it tracks production in sectors like coal, electricity, refinery products, cement.
Okay.
So, it gives you a pretty good snapshot of overall industrial activity.
So even amidst that slowdown, there are sectors showing some strength.
Yes, definitely.
That index of 8 core industries, it sounds like a valuable indicator to track.
I think so, yeah.
For someone trying to understand, India's economic pulse, what's the key takeaway from that 4.6% growth figure?
Well, it suggests that even though manufacturing overall is facing challenges, certain core sectors are performing well.
Okay.
And this could be because of things like, government infrastructure spending or, that sustained domestic demand for these essential products. And so it's a sign that the slowdown, it's not impacting all parts of the economy equally.
Interesting. It seems like there's a lot going on within India's economy. Some areas doing well, others struggling. But we can't forget that global context.
Right.
What international news kind of caught your attention in the Chartbook?
There were a few noteworthy global developments, actually. The Bank of England, they cut their key interest rate by 25 basis points in February. They cited progress on taming inflation, but also acknowledged worries about economic growth.
So another major central bank easing monetary policy.
Right.
Is this becoming like a global trend?
It certainly seems so. In fact, the People's Bank of China, they also left their loan prime rates unchanged in February. So this signals a pause in their easing cycle after those cuts in October 2024. And this suggests a more cautious approach, as they kind of assess the impact of those previous easing measures.
What about the U.S.? The Chartbook mentioned some key economic data releases.
Yeah, the U.S. economy it's sending kind of mixed signals, actually.
Okay.
On the one hand, U.S. GDP grew by 2.3% in the fourth quarter of 2024, which is decent.
Yeah.
But, retail sales took a tumble in January 2025, and consumer sentiment weakened more than expected in February.
So some signs of slowing down in the U.S.
Yes.
How concerned should India be about a potential U.S. recession?
Well, a U.S. recession would definitely have those ripple effects on the global economy.
Right.
And India wouldn't be immune. It could impact demand for Indian exports, make it harder to attract that foreign investment, and even, create some volatility in those financial markets.
And how about inflation in the U.S.? The Chartbook mentions the PCE price index,
right,
which is, I believe, the Fed's preferred inflation gauge.
That's right, yeah. The PCE price index, it rose by a modest 0.3% in January 2025, bringing the annual inflation rate to 2.5%.
Okay.
So that's still above the Fed's 2% target.
Right.
But the slowdown in inflation is giving them some breathing room.
Mm-hmm.
They're likely watching those data points closely as they decide on their next move on interest rates.
So a lot of uncertainty around those Fed actions.
Yeah.
Any other notable international news?
Well, Germany's economy contracted by 0.2% in the fourth quarter of 2024, officially entering a recession.
Okay.
And so that's a sign of weakness in the Eurozone, which could have implications for global trade and investment flows. On a brighter note, though, Japan's GDP expanded by a stronger than expected 0.7% in the same quarter.
Okay.
Driven by pretty robust consumer spending and business investment.
It's a real mixed bag out there.
It is.
Some economies slowing down, others picking up steam.
Yeah.
It seems like navigating this complex landscape is going to be a real challenge for India.
Indeed. India's facing, a multifaceted economic situation. We've got that strong domestic demand, a booming services sector, easing inflation. Those are positive signs.
Yeah.
But those global headwinds, the widening fiscal deficit, and those uncertainties in the financial markets, those pose some significant challenges.
It sounds like the next few months are going to be really critical.
I think so, yeah.
For understanding what direction the Indian economy is heading in.
Definitely.
What signals should our listener be paying closest attention to in order to kind of anticipate those future economic trends?
That's a great question. And the perfect segue into our final part.
Okay.
We'll delve deeper into that, focusing on those key indicators.
All right.
That can give us some insights into India's economic future.
Okay, so we're back for this final part of our deep dive into the Indian economy. We've covered so much: GDP, inflation, those jittery markets, and this global economic roller coaster.
Yeah.
So, what does it all mean for India's economic future?
Well, I think India's at a crossroads, trying to navigate this really complex landscape with both opportunities and challenges. We've talked about those positives, the strong domestic demand, the services sector doing really well, and inflation moderating.
Yeah.
But we also have to remember those global uncertainties, the widening fiscal deficit, and that nervousness in the markets.
Right. It's a real balancing act.
It is.
So for our listener out there who's trying to make sense of all of this, what are the key signals to watch closely to kind of anticipate what's coming next?
I'd say really understanding how domestic and global factors play together is going to be crucial going forward.
Okay.
First, keep a close eye on global economic developments, like Will the U.S. slip into a recession?
Right.
Will the Eurozone stabilize? What impact will China's reopening have on global demand?
Right.
These global trends, they're going to directly impact India's exports, investment flows, and just the overall economic mood.
So it's not just about staying informed about the global news. It's about connecting the dots.
Right, exactly.
And understanding how it can impact India.
Exactly. Think about those ripple effects.
What about domestic signals? Like what should our listeners be tracking on that front?
I think inflation's a key indicator to watch.
Right.
Will this recent easing of inflation continue?
Right.
Or will those rising energy prices or potential supply chain disruptions, push it back up? The RBI's actions are going to be crucial here. Will they cut rates further to boost growth? Or will they focus more on keeping inflation under control?
It sounds like those RBI policy decisions, they're going to be like major signposts.
They will.
What else should our listener be paying attention to?
Keep a close eye on the government's fiscal policy.
Okay.
Will they take steps to rein in that widening fiscal deficit?
Right.
Or will spending continue to outpace revenue?
Right.
This has major implications for inflation, for interest rates, and just the overall health of the economy.
Okay, so the government's budget decisions, those are important to watch.
Absolutely.
Anything else on that domestic front?
I'd say track private investment and consumer confidence. Are businesses feeling optimistic enough to invest and create jobs?
Right.
Are consumers confident about the future and willing to spend? These factors are crucial for sustaining economic growth.
It's quite a list. Global economic trends, inflation, RBI policy, government spending, private investment, consumer confidence. But it sounds like the key takeaway here is that India's economic future hinges on this really complex web of interconnected factors.
Exactly. By understanding these connections and watching for those signals, our listener can gain some really valuable insights into where the Indian economy is heading. It's about seeing that bigger picture, understanding the forces at play, and being able to anticipate those potential shifts and turns along the way.
Really well said. We've given our listener a lot to think about today.
Yeah.
Any final thoughts or parting wisdom for our deep diving friend out there?
I'd say this. India's economy is dynamic and resilient. It's faced challenges before and emerged even stronger. I think the key is to stay informed, be adaptable, and remember that these economic trends, they're always in flux.
Great advice. Thanks for guiding us through this fascinating deep dive into the Indian economy. And to our listener, thanks for joining us. We hope you've gained some valuable insights to help you navigate this complex landscape. Keep exploring, keep learning, and we'll catch you on our next deep dive.